Good morning. Welcome to the Brew. I'm back, and I'm Lex. We're back from France on our 12-day journey over there. I hope you saw a few snippets from overseas. Today, Mark and I are going to break down zero DTEs and SPX. Interesting email came over from SIBO, and we're going to kind of break it apart and see what we can get out of it. So be ready for that opening bell because we're going to get back into the Brew Live. Good morning, Mark.
Lex, it's good to see you. We got French Lex back.
You got French Lex back. I even bought the scarf. I had 2 scarves. So I definitely got 2, and I learned how to tie them. When we were up in Normandy, our guide kind of had that scarf on. It was a little chilly up there. I need one of those. That looks great. So,
the summer scarf is a look I think we absolutely need to adopt over here. It's so versatile.
It is. I didn't go with the beret, though. I looked for one. I'm like, that might be over my pay grade there. I don't know if I can handle that.
A couple more weeks there, and you'll be able to fit into one.
Right. I know we can't go right into zero DT without talking about France, since you were there for like 900 years. You're back back at home now, though, right?
I am. I'm back in Connecticut now. So it's almost like we were ships in the night, and you headed over to France as soon as I was heading back here.
That's right. It was a great trip, though, and we did some cool things. So good.
Okay. Good wine.
Yeah, great wine. You know that. I mean, I kept sending you pictures of the wineries and what I was drinking. So, Gal, what can I say?
Well, put in a plug for the Bandol region. That's some of the red, white, or rosé. Those are fantastic.
We were in Bandol. I copied down those 2 wines I sent you from that region that were just outstanding. I don't think we're going to find them here, but maybe I'm wrong. We'll do our best. So
I got some tips for you. You'll have to subscribe to my premium channel to get my wine recommendations too.
I love it. All right, let's get busy. So no Jason today. We actually don't know where he is. So, I mean, we know he's safe and everything, but we don't know where he is because he was all excited to be here today. So we're going to talk a little bit about some of his stuff. Now, we don't have him here to refute anything, but we're going to talk about it anyway, right? So, Mark, SPX, zero DTE, it's kind of the rage. It doesn't go to bed. It doesn't subside. It looks like volume is averaging over 1.23 million contracts, which is about 500 billion notional per day throughout 2023. That seems like a lot. I think it's some big percentage of the SPX overall flow. Have you heard the similar things?
Absolutely. And I think right now, I believe the year-to-date average is a little over 40% of SPX volume.
Is that right?
So, right, like if SPX zero DTEs are averaging 1.2 million, that means SPX itself is trading, 2.5, 2.7, something like that, which is roughly correct to me. And I think that actually, I don't have the specifics, but that number's been increasing. So I think in the last couple of weeks, I've seen numbers where zero DTEs printing over 50% of the volume in SPX.
Right. So, here's my question to you, and I'm not sure we have an answer, but let's try to figure it out. Everyone's asking, why is there so much interest in this type of a product? What is the allure for a trader? Now, I'm not talking about a market maker trader necessarily. They have to just respond to markets, right? I'm talking about a retail person or even an institutional type entity for zero DT. What's the just the sum attraction of something that's expiring today?
Yeah, so I think there's both a retail use case and there's a professional use case. But kind of before that, I think one thing that's like important to think about when you're talking about zero DTEs is that zero DTE isn't new. It's existed since the first call was listed on the CBOE in 1976. Expiration Friday has always been zero DTE trading, right? Market makers, dealers, everyone's always dealt with options that expire that day. That has literally existed for 40 plus years.
Right.
So in putting that into context, now there are ones that happens every single day, but expiration is a process, and the unwinding of gamma and theta and all that, that's a normal process that happens with any option on the day that it expires.
Sure. So what the zero DTE you're saying then really refers to is that since we've already had zero DTEs by nature of what you just said, now we just have it all the time, at least in SPX and maybe spiders, right?
Correct.
So every day is an expiration essentially. So that's kind of the catch-all of zero DT. Now you just have them all the time. It's Monday through Friday. You have an expiration.
Right. It used to be there was the third Thursday of the month that mattered, or the third Friday, or the Friday before the third Saturday of the month, and then it was just the third Friday, and then it's every week, and now it's every Monday, Wednesday, Friday, and then it was every day. So yeah, it's just a sort of acceleration of a trend that dealers, market makers, the community's been managing for a long time. But to get to your original question, like why does a retail user want these? Why might a professional user want these? Both buy side, right? Not liquidity takers, they're there to trade the flow. But from a professional perspective, right? A professional buy side trader's perspective, I think the easiest way to think about them is that they're cheap Greeks. And they're an interesting short-term way to patch up gap risk, patch up coverage for an event. FOMC is happening. Great time to patch up a little downside for relatively cheap. It's an interesting way for people, for professional traders to make plays on the difference between intraday volatility and overnight volatility. That you have a security that's going to expire at 4 o'clock. You have another one that's over the next day, so you can start to do some interesting kind of intra-asset plays on variance on different sections of the curve. So all of that makes markets more efficient at the end of the day too, right? So the reason I talk about the professional trader first is that these are the ones, along with market makers, that are putting markets in line, right? That are pricing these appropriately and whatnot. So because of their potential use cases to manage large books. So I think overall, one way I think of the professional use case is just that cheap Greeks. It's a short-term, cheap exposure vehicle.
Do you think? Yeah, I agree with all that. By the way, do you think that the I'll just say normal retail trader is is he or she using the zero DTE to sell premium, to harvest theta? Take a drink. I don't have my coffee cup today. To harvest theta, or is it the other way around? I almost, my feeling is I'm guessing they're trying to gain a little bit of theta decay with a quick strategy in the early morning, take it off, not at expiration time, but when it gains a certain percentage, whatever it is, a spread, a condor, whatever, and then being done with it. They make their 20, 30, 50 cents and move on. That's my suspicion, but I don't know. What do you think?
So the SIBO, actually, to plug them again, they put out another really interesting report about a month ago at this point. And to plug myself, I wrote a blog about this. So you can check out my blog either at the Tradier Hub. It's available. It's called Responsibly Short if you go to the Tradier Hub, or it's at the.substack.com. But exactly what you're suggesting is...
Mark, hold on. Was that a plug?
That was a plug for the Hub.
That was a plug for the Hug and Mark at Harvested Financial. Hold on. Any plug gets a bell ring.
Oh, thank you.
You're welcome. All right. Sorry. Go.
So what's pretty impressive about what retail is doing is the vast majority, I believe it's 95% of these strategies that are coming from retail is some sort of spread or defined risk trade.
Okay.
So they're not selling naked calls. They're not selling naked puts or even cash secured puts. That for the most part, what they're doing, overlays count, right, as a protected spread, as does any debit trade is of course defined risk on the buy side. So this could include some naked buys, but for the most part, when they are putting on shorts, and I think they are more biased to shorts than long. If I recall, it's like 2/3, 1/3.
Okay.
They're selling put spreads. They're selling call spreads. That it's verticals that are designed to collect that premium that they tend to engage in the beginning of the day. That sort of 9:30 to 10 a.m. Eastern window, first half hour of the day. They're slamming the theta, and then towards the end of the day, buying it back. Market moves by lunch, by the close, and so they're settling into those by the end of the day. But I think there is definitely a bias currently towards premium collection strategies.
Sure, I agree with that. I think that's probably right. I think if I were using the product as a not a market maker, more of a retail, I think that would probably be my strategy, assuming, implied volatility met up and, it was an advantageous, IV value play. I think I'd use it that way myself. You feel the same?
Definitely. And I'm a huge fan of spreads, obviously. Like, I think that's the way to play this, right? Like, it helps you manage your capital, your margin, you manage your risk. Like, selling put or call spreads, butterflies, obviously interesting too, condor, there are a lot of different ways you can play it directionally but a spread, I think, is the best way to do that. And, frankly, this vol environment, to steal a line from Jason that I steal enough that maybe I can get co-branding on, is, when vol's low, it might not be low enough.
Right.
That, like, I actually think this market environment, speaking to this week, the last month, the last 2 months, has been a good short vol environment for retail spreads.
Yeah.
Because we're, realizing not much less, but less than, IVs are suggesting.
Right. No, I agree with that. I think that's right. Here's another interesting comment, right? So there, I guess the point is, some commentators, in the press, may be blaming 0DTEs for exacerbating SPX index volatility, or suppressing it for that matter. So it's either exacerbating or suppressing volatility. They're contradictory headlines. I get it. Who's right? Is it happening? Do you think, because here's what happens. Where I'm going with this. We're going to the dealer gamma right here. And are the dealers moving this index around because of 0DTE that they're taking the other side of?
So I'm going to get meta here for a second and say whether they're exacerbating volatility, whether they're suppressing volatility, whether, are people buying these and getting dealers short gamma? Are people selling them and making dealers long gamma? Are they buying calls? Are they selling calls? Are they buying puts? There's so many different paradigms. And I know Jason has some good names. We have the Citial paradigm. We have the Bank of America paradigm. We have, the net short, net long paradigms. Like, there are a lot of different things that, different positions that can get put on, of course. And I think that's just flows. Mm-hmm. That's just the market. The fact that there is no systematic structure is just a market behaving exactly the way a market should behave. It's adapting and pricing, and when vol's too cheap, well, the strategies that come in and buy are going to come in and be more buyers than sellers, and vice versa. So I think the fact that there's no consensus about this is actually a very robust and healthy sign for what's going on here. That there isn't a single omnidirectional use case here, right? That there's a lot of different flows pushing and pulling in different directions, the way a market should.
Yep. No, I agree with that. So here's what SIBO says. And, let's go to the remarkable real quick, if we can. I kind of wrote it out a little bit. So we talk a lot about gamma exposure, especially when Jason's on, right? And I'd love for him to be on to kind of corroborate this or not. But you can see what I wrote here. Gamma exposure. This is directly from SIBO. They see every trade, SIBO sees every trade that goes on in SPX. It's their product. So they have exact customer flow and market maker flow, et cetera, and they break it down. Here's what they're saying. Gamma exposure for the dealer is only between 170 to 670 million gamma, okay, during the day, right? In a 400 billion notional per day sort of number at SPX at large. That's de minimis, as they say in their article. It's 0.17% to, 0.04% to 0.17% of S&P liquidity. So it's not a big gamma exposure, which means then that the dealers really aren't, pushing things around. So it's hardly the tail wagging the dog, as they also say in their article. Any thoughts on these numbers?
Yeah, I definitely agree with that. And I think, I've long felt that it's important to put the, overall volume here in context of the big product that we're talking about. And so just to set the table a little bit, the idea would be that all this gamma exposure is something that the dealer has to hedge. That to the extent that the market moves, this, gamma exposure is going to translate into deltas that the dealer has that they're going to need to flatten in one way or the other. Mm-hmm. And the most obvious way is to trade, E-mini futures or some S&P futures product. And because, this gamma exposure is, exploding due to all this volume, then, that's going to necessarily cause a lot more dealer hedging. It's going to push the underlying market around. I think to the explosion in volume point, right, it's one of Sibo's points is that it's going both ways, right? Mm-hmm. Customers are both buying and selling, of course. And so that notional gamma number is gonna be the net of all those buying and selling. So mm-hmm. even if 1.2 million contracts are trading hands, that's not all buys and that's not all sells. Right. And then putting that in context of the overall E-mini market, I think in the short term, there are going to be flows. You know this from the floor, right? If someone comes in with a big order, you're going to fade that bid immediately, right? The dislocation of flows is kind of what makes a market. So if all of a sudden dealers get slopped with a big trade, they might push the E-mini market one way or the other. There might be some of that tail wagging the dog effect,
right,
on a short-term horizon. I think what this is showing, and I think what we've seen overall, is that it's not nearly enough to really be pushing this market around the way that some commentators might say it is.
Mm-hmm. Yeah, I agree with that. I think that's right. When I first read the article from Sibo, and it, by the way, it's a fascinating executive summary, I guess they're calling it. But you can go to Sibo and probably get on this list. I subscribed because I thought it was interesting. I have not read the full report yet, but I do want to read that. I first read the 170 million to 670 million as God, that seems like a lot. And then all of a sudden I kept reading, and I got to the 400 billion notional. I'm like, well, that's a fraction. So all of a sudden it doesn't seem like so much. But yeah, I think you're right on all points there. Interesting product. I'm wondering if they bring this to other, equities. Apple, Tesla. Are we going to have an expiration every day? What do you think?
I think that's inevitable. And I think, being in the business of managing inventory and whatnot, market makers are going to grumble a little bit about it in the beginning. It's all of a sudden a bunch more strikes. It's more market data that they have to process. It's, more, their balance sheets aren't getting any bigger, but now they have to add a bunch more risk exposure in a lot of different places. So, it's definitely a short-term cost, but I think from what we've seen in the SPX complex, it's been a growth of both organic players. It's both been an organic growth of existing players that are trading more, and I think it's brought new people into the market too. Mm-hmm. So to the extent that happens in your Class A liquidity products, your Apples, Nvidias, I think that's not going to be a good thing for the marketplace.
Yeah. Okay. Fair enough. One of the things, do you know, is 0DT at Spiders? That's SPY now as well. I think it is.
Yes. So Spiders and Qs have them, as does SPX and NASDAQ.
Okay. So that's good. I think some of the more automated shops tend to like to trade the penny type options, which is a Spider, a QQQ. It's not an SPX though. So those are nickels still, I believe, at their smallest. I think you could probably put stuff in between if you're a retail person, but I think it's quoted in nickels and dimes, if I'm not mistaken. Does that sound right?
100%. I forget the exact name of the mechanism, but there's an automated improvement. AIM is the term in equities. Okay. In SPX, there's a customer improvement. So the previous study that I mentioned that the Sibo put out about the SPX flow, mostly focused on order flow, retail order flow that specifically went through that. And the price improvement that retail's getting by sending orders there is actually pretty incredible. That the effective spread, so usually SPX is actually a quarter wide, but the effective spread for retail is actually closer to 6 pennies. So 6 pennies on a $4,500 product, that's an insane price improvement stat, right?
That is. I agree.
So, you can say that, okay, retail is paying the spread on, 1.2 million contracts a day. Well, that's not all that's retail. I think retail is only like 30% of it. So 400,000 contracts a day, retail sending in here, giving up 6 cents. That's $6. Oh my gosh, look at all this edge that they're losing. It's like, no, this is class A world tier liquidity, right? Like there's really good price improvement that are,
Sure.
fractions of a vol point that people are really getting effectively.
Yeah. Guess who's my door's knocking? Guess who's here?
Uh-oh.
Jason finally showed up. Let's open the door. And what the? Would you oversleep?
No. We just had a family thing that was very urgent.
Okay, I hope everything's okay. Good to see you.
Yeah, everything's all right.
Okay, perfect.
Well, we set the table for you, Jason. I am really looking forward to hearing from you.
We set the table. I'm gonna do it paraphrase real quick, and you're gonna give us your Volland analysis. So we're talking about zero DTE.
Okay.
Mark and I kind of went through a little expose and chatted about it a little bit. Coming from the SIBO, who sees all this data and sees all the stuff that you produce in Volland and what have you, a customer versus market maker order flow. SIBO generally is saying in this article that the gamma exposure for dealers is de minimis relative to the overall notional trading value of SPX. It's around 170 million to 670 million throughout the day in a 400 billion notional environment of SPX, which is, they claim hardly the tail wagging the dog. Do you have a theory on that, or do you believe it, or are you anti it? What are your thoughts?
I completely agree. I think that the exposure that we see in Volland is primarily on a monthly or longer time frame.
Okay.
The other thing too is from a volume standpoint, zero DTE obviously is extraordinarily high. It's like 600. What is it, like 60% or 50% of the volume during the day is zero DTE.
Yep.
However, one option on zero DTE is not worth the same as one option 1 month out or 2 months out, right?
Sure.
Mark,
Makes
like
sense.
you can tell me the gamma exposure on one option 1 month out is wider ranging than that of zero DTE. And also one on zero DTE, yes, at the strike, gamma is higher, but its sphere of influence is so much more narrow that you're not going to get a massive move strictly based on zero DTE notional values. You're not, unless the only way that would happen is if, let's say, there's some kind of sell-off or something, some liquidity event that it's going to cascade and people are going to keep, selling zero DTE options or whatever. There is a path to a liquidity event, as far as a tail wagging the dog kind of thing on zero DTE. That is if customers are net sellers and they are not hedging, they can get into a bad, situation liquidity wise and get margin called. But overall, I do agree that it is not as much the tail wagging the dog, like on a grander scheme,
right,
than has been made out to be. Now, on an intraday scheme, when you're trading on 5-minute ticks and 10-minute ticks, maybe, yes. I think that zero DTE has a huge impact. But when like a level is broken or something like that, when I call them lines in the sand, and when I talked about it in Volland, when that's broken, that results in, 10 points in a minute, in like 3 minutes, not 100. So yes, I completely agree with SIBO that the notional gamma on a wider scope is much higher than it is on the narrow scope of zero DTE. But if the market's not moving much, zero DTE does rule the day. And that actually happens probably about 75 to 80% of the time. Like 1 out of 5 days will work against zero DTE from a Volland standpoint.
Right. So you guys remember Chris and Will from Ambrose Group, right? That's a plug. I gotta hit the bell. I think their executive summary on this event was similar. Were they on the side of saying that there isn't as much volatility because of zero DTE as people think, or were they the opposite? I think they were on the same line we are. Is that right?
No, I mean, when I read the Ambrose Group paper, first, my understanding was they believed that overall more options were sold than bought.
Okay.
While that may be true on the extreme wings as the market opens, at the money where the notional Greeks are the highest, that's not true. It's actually kind of like a mix. It depends on the day whether it's more bought or sold.
Okay.
That's what makes a good market, right? Like if it was consistent, it wouldn't be a liquid and efficient market.
Right. Yeah, I mean, and it's funny how, like, after 10 o'clock, 11 o'clock, things follow along with the 0DTE, unless, of course, it's like, an FOMC event or something like that. There's some macro event. So, yeah, I mean, but their conclusion was that this could set the table for a big liquidity event.
Right.
I think that the chips have to fall perfectly in order for that to happen.
Which
it could happen.
Yeah.
But I think the chips, like I said, I think things, the behavior of customers, the dealer, the dealer hedging is fine. They're handling the risk just fine. But in particular, the risk management of customers is the only thing that can cause a massive downturn. And I think they said that in the Ambrose paper. I think that was one of their conclusions.
Right.
However, I do think it was a little bit overstated in the Ambrose paper.
Got it. You want to have...
We were talking about this a little bit earlier, but the SIBO put out a paper like a month ago where they analyzed the retail flow, and 95% of the retail strategies were in some sort of defined risk structure. Whether that's a long debit, whether that's a credit spread or spreads or an overwrite. Like for the vast majority of customers, they're not getting into naked positions. And like, I think, so I kind of discount that potential as, a spark point for any kind of like volatility event. And I think dealers are in the business, of managing risk. So like they've been trading expiration since 1976. Like none of this is new. So the fact that they have to do it every day is just, an adaptation there that fundamentally expiration is something that exists in options. And also to the extent that like anything was predictable here, right? Like efficient markets are going to stamp that out pretty quickly. Like if dealers are mispricing these, like, or whatnot, like they're going to adjust the curve or they're going to adjust the way they model these. So I think, any systemic risk or contagion from this, I think is dramatically overstated.
Agreed.
Interesting. Okay. All that makes sense. Jason, I was telling Mark too, you might want to, if you haven't done so already, subscribe to this report that SIBO sends out. I found it interesting. So I did subscribe.
I did read the SIBO report. But it was more statistically based. It was like, what are the, what's the volumes, what's going on. Yeah, and I liked it. I actually I sent a note into Henry about it, like, hey, were you a part of making this?
Yeah, good. But I want to get Chris and Will on for one of our spots here from Ambrose and talk to us. So I've reached out to Chris a couple times to see if he can come on. So I'll work on that. And I'd love to hear, get into a little discussion with him about this stuff as well. So they're big tail, fat tail traders and all that kind of stuff. Yeah. So it would be kind of interesting, I think. Okay, what else? Do you have some stats for us today, Jason, before we bug out of here? What are you thinking?
Sure, I can talk about Volland real quick. Hold on.
Yeah, go ahead. Let's we'll go 3 to 5 more minutes. And do you need to share a screen or anything?
Yeah, hold on. Let me bring it up. Oh, that's why.
Mark, this is the time in France time when I would be cracking open a bottle of rosé about now.
Yeah, that is something I miss about the shows there is I'm going to have to transition from having like a nice glass of rosé to a cup of Joe.
Yeah, I know. Not the same, right?
Not the same.
Why though?
Why? I need to dry out. Are you kidding me?
All right, let me make sure that this is the one. Yeah, I got yelled at by my wife that whenever I share these things, my bookmarks are all up there. And
Yeah, do it the right. Just share the what do you call it? You don't have to
I
share the
got
whole screen. You can share the window.
Yeah, that's what I do.
All right,
Even
let's
the
see
window
it.
has my
Go,
bookmarks
baby,
and
go.
tabs
Look at
there.
this. All right, what do we see
All
here?
right, so here's the thing. I did the all expiration Vanna. Obviously, when we were up at 4,500, this area right here, which seems to now be mostly muted. When we were up here, there was a lot of Vanna at that point. And I kind of said that this would be a magnet. It would be, it would be basically our sun, and price would be rotating it like a planet. We've gone above it, we've gone below it, about 30 points.
Mhm.
Probably for the week we would surround it. Although I do have to check to make sure that that Vanna is still there. It looks like it seems to be overshadowed a bit by some of these things.
Right.
Overall, though, I mean, a lot of these strikes are out until the end of the year. And this, if we do have downside, 4,300 would be a large strike.
Is that what that spike is?
Yes.
I can't see it on my screen very well. It's small for me, but so that's 4,300.
Hold on.
Okay, we're
So
at
there
40.
we go. 43 and 4,350 is the spike for this is all the way through September expiration.
Okay.
And it looks like I guess 4,500 got closed out quite a bit.
Yeah.
But yeah, I mean, so this is gonna kind of tell you that we're gonna be kind of compressing here. We're probably gonna have a little bit of vol compression unless volatility spikes. In which case 4,350 could be a target. 4,400 will be a target, and it can, if vol spikes, things can get pretty ugly.
What's the big red spike on that graph down below the 4,300 line? Well, yeah, that one.
43.25.
So that's that they're long gamma down there, right? Is that true?
This is Vanna. So
I mean, I'm sorry, they're if they're short Vanna, they're going to be long puts down there, right?
Yes, so they're long puts down there, and dealers are short puts up here. So it's almost like they have a vertical on.
Yeah, that's right. So they're it's got 25 points of issues before the dealers kick into the other side.
Right. I think that what would have to happen, like I said, would have to be a vol spike, and that we would have to reach this 43.50 area to actually start looking at some kind of gamma cascade to the downside.
Got it. Okay.
I know a lot of people are kind of afraid, that we've had quite a few down days in a row here. But yeah, I haven't seen in a while 4,500 not having that much of a impact anymore. I guess people sold off their positions, huh?
Yeah.
Yeah, I got to do another analysis.
Okay.
I was going to actually start going on the option hub. I was going to start doing the option hub with like an analysis on a weekly basis. So there you go. There's my option hub plug. Or not option, Tradier
That's
hub.
okay. I'll get it. Don't worry. Tradier hub. Jason's trying to say Tradier hub. Ding it again.
That's the second hub plug we've gotten today.
We got 2 hub plugs today. It's unbelievable. All right, good. I know Mark's a
Seriously,
professional.
though, check out the hub.
Yeah. Mark's a
So I'm
professional.
going to do like a weekly. I'm going to start like a weekly like Greeks of the week kind of thing.
Got it.
And if anything pops out, I'll probably do a one-off. But
Good.
Mark is the person to follow for anything profound. For me, it's anything Volland.
I love it. All right, guys.
Mark
good.
is very profound. So
Let's take a quick look at the markets. I'm looking at them myself, but if we could pull that up, it's Mark, you were saying that the Nasdaq looks like it's down pretty good. It's down 1.25%.
I think this is more Apple news. Apple's really taking it on the chin from China.
Okay.
Yeah.
What's going on there again, Mark? Sorry, I know you said it earlier. Just repeat for everyone.
I don't recall what the exact specifics are, but it's something about like an iPhone ban. Jason, sounds like you know more.
yeah, I read about it yesterday and again this morning. iPhone has been banned, or government officials have been banned from using iPhones. I guess they believe that Apple, like we believe in Huawei, is spying on Chinese government officials. and I guess Americans believe Huawei is spying on American officials. So it's just
I feel like everyone's spying on me.
Friends.
I think everyone's spying on me anyway. So what's the difference? I got a chip in my neck. I found out. What the heck?
Oh,
yeah, exactly.
Your wife is a spy.
Yeah, but you just came back from the land where the spies are like Cary Grant hopping along like some Côte d'Azur coast, as opposed to some tech bros in the basement.
I think you're right. I think you're right. All right, cool. So I got to be honest. I didn't pay attention to the markets a ton overseas. And now that Jason, I think Mark, you mentioned it too. We've had several down days in a row. I didn't get that flavor from back home. But I'm looking at the numbers of when I left, I could have sworn it was around 4,400 SPUs, and it's still right around there. Was it higher than that when I left? I don't remember.
When did you leave?
Well, it seems like a month ago, but it was like a week and a half ago. I could look, I suppose.
It got up to about 45, 50 again, and then it turned back down. Yeah, I mean, this is macro news. I mean, there's nothing much that I can that Volland can tell you about the activities of Chinese delegates, but yeah, I think this is mainly a Apple thing, and I think the other thing too with Apple is their supply chain is basically based in China, so they could do anything they want in reality. Yeah. Yeah. So I mean, it's kind of Apple can be caught in a political crossfire here. Yeah. Okay. Good. All right, guys. Good to be back. Good seeing you, Mark. You're good to be back too in America. From my perspective, but I know you'd rather be back in France. I was kicking butt on the language though. I got to tell you. I think Mark's frozen, by the way. Oh. He's like one of those Disney characters in the movie when it freezes. Just kind of look at him. He can't even move. He's trying to move his eyebrows, move his head. It's like getting Botox. You can't move or something like that. All right, guys, we're gonna go. Good, Jason. Good to see you. We'll talk afterwards. Yeah, good seeing you. When you unfreeze, we'll talk to you. So everyone, be good. We're back tomorrow. We'll have Paulina on from CNBC. We're gonna be talking more 0DTE on Monday too with OIC. So there's a lot coming up. So tune in and Jason, new time. We're talking 9 o'clock Central. Max and team are going to put that out in social media when we start the 9 o'clock routine. So that's Central. Yeah, I thought that started today, actually. Yeah, I know. You're sleeping in again. There you go. Yeah. All right. Good to see you guys. That's a wrap. Close it out. We'll see you Monday. All right. Take care, Lex.